Thanks for tuning in today's video, we're going over the companies I'm buying or planning to buy for the month of November. I'll walk you through each business, what they do, and the key fundamentals. Then we'll run through a simple valuation estimate using earnings, growth assumptions, and target returns to see whether the current price makes sense or if there's a better entry point. If you enjoy dividend investing, long-term compounding, and breaking down quality companies, this one is for you. Let's start with Automatic Data Processing, better known as ADP. It's one of the world's largest providers of human capital management solutions. The company offers cloud-based software and services that help businesses manage payroll, benefits, HR, time tracking, and compliance. They serve companies of all sizes, from small businesses to large enterprises, and handle everything from payroll processing and tax filings to more advanced functions like talent management and workforce analytics. Because payroll and HR are essential recurring services, ADP benefits from steady, predictable revenue, and its business model is highly resilient even during economic downturns. It's considered a sleep well at night stock in the dividend growth world due to its long track record of profitability, consistent cash flow, and over 5 decades of consecutive dividend increases. When we look at the revenue, this indicates that ADP has been growing its top line at an average of 6.5% per year over the past decade. While not explosive, it's very steady and reliable growth, especially for a mature service-based company. It shows that ADP continues to expand its client base, increase prices modestly, and cross-sell new HR solutions. When we look at the net income, earnings have grown faster than revenue, which is a great sign. It means ADP has improved its margins over time, either by controlling costs, automating more processes, or shifting toward higher margin digital solutions. Free cash flow is the lifeblood of any dividend company, and ADP's double-digit free cash flow growth highlights how strong its business model is. This growth provides the fuel for consistent dividend increases, share buybacks, and reinvestment into technology and acquisitions. Earnings per share growing over 13% annually is impressive and reflect both profit growth and share buybacks. EPS growth outpaced revenue suggests that management is creating real shareholder value through efficiency and capital allocation. When we look at the dividend growth, a 12% dividend growth rate over a decade is exceptional. It shows ADP not only has the earnings power, but also the confidence and consistency to return capital to shareholders year after year. Combined with their long-term dividend streak, this makes ADP a true dividend growth powerhouse. When we look at the shares outstanding, ADP has slightly reduced its shares count over the past 10 years. While modest, it still adds value because it boosts EPS and dividend per share growth over time. The company isn't aggressive with buybacks, but it uses them strategically and sustainably. Now for the P ratio, ADP typically trades at a premium valuation, reflecting its quality, stability, and consistent growth. A P ratio of 25 is slightly below its historical range, which could signal a fair or slightly undervalued entry point for long-term investors, especially given its track record of reliable compounding. Now let's talk about valuation and return expectations. ADP's current earnings per share sits around $10.14, and over the long term, I'm projecting about 10% annual EPS growth. Given the quality and consistency of this business, I think a fair multiple for ADP is around 28 times earnings, which is in line with where it's historically traded when sentiment is neutral to positive. Using those assumptions and a desired annual return of 10%, I ran the numbers starting from today's price of about $254 per share. Based on those projections, ADP will deliver an expected return of roughly 12.5% per year, which actually exceeds my target return. To hit exactly a 10% expected return, my fair entry point will be at around $283 per share. So even at today's prices, the stock looks recently valued to slightly undervalued, especially when you factor in its reliability, dividend growth, and the consistency of those earnings. In other words, ADP doesn't often go on sale, but even at current levels, it offers a solid risk adjustment return for long-term dividend investors. The next company we have is S&P Global. S&P Global is one of the most influential financial infrastructure companies in the world. They provide credit ratings, financial data, analytics, market intelligence, benchmarks, and global indices, including the S&P 500. The company essentially acts as the backbone of global financial. Banks, government, asset managers, and corporations all rely on S&P Global's data to make investment decisions, assess risk, and comply with regulations. Their business model is incredibly strong strong because their data is essential and mission critical. Demand is consistent across all market cycles, switching costs are extremely high, and their margins are some of the best in the financial sector. This combination has made S&P Global one of the most consistent compounders in the market and a top-tier dividend growth stock. When we look at the revenue, S&P Global has grown its top line at nearly 11% annually for a decade, which is impressive for a company of its size. This growth is driven by stronger demand for financial data, more credit rating activity, and acquisitions that expanded their analytics and intelligence segments. Earnings have grown significantly faster than revenue, which means margins have expanded. High-margin data products and subscription services contribute to this outperformance. When we look at the free cash flow, this is one of the biggest strengths of the company. S&P Global generates massive amounts of free cash flow and is growing at nearly 18% annually. This gives them the ability to aggressively raise dividends, buy back shares, acquire new businesses, and continue reinvesting in higher margin segments. The earnings per share have compounded at over 15% per year, which reflects strong profit growth, ongoing share repurchases, higher margin revenue streams. So this means this type of EPS growth is elite. Very few companies maintain this level for a decade. Now, with over 11% dividend growth annually, S&P Global remains one of the most reliable dividend raisers in the financial sector. They don't offer a high yield, but the compounding rate makes up for that. When we look at the shares outstanding, S&P Global has reduced its share count by just over 2%. While not aggressive, the buybacks are steady and add incremental value to EPS and dividend per share. A 35 times earnings multiple might seem high, but S&P Global has traded at a premium for years because of it. A 35 times earnings multiple might seem high, but S&P Global has traded at a premium for years because it has extremely high margins, mission-critical data, consistent double-digit growth, high free cash flow, near monopoly position in several segments. For a company executing at this level, a premium valuation is normal. In short, S&P isn't cheap, but great businesses rarely are, and it continues to justify a high multiple through performance. Now let me walk you through my valuation projection for S&P Global. I'm working with an EPS estimate of about $13.75 and assuming 11% annual earnings growth, which is very much in line with S&P Global's long-term performance. For a company of this quality with high margins, recurring revenue, and a near monopoly position in financial data, I think a 38 times earnings multiple is fair and consistent with where the stock historically trades. With those assumptions, I set my desired return at 12% per year, which is what I look for in higher quality compounders like S&P Global. Starting from today's price of around $493, the projected return comes out to roughly 12.26% annually. S&P Global is the kind of business where you rarely get deep discounts, so any pullback will make it a very attractive add for long-term dividend growth. The next company is Mastercard. Mastercard is one of the world's largest global payment networks. Every time someone swipes, taps, or enters their card number online, Mastercard sits in the middle of that transaction. They don't issue cards and they don't loan money. Instead, they operate the payment rails that connect consumer, banks, and merchants. Their business model is incredibly profitable because they take a tiny fee from each transaction, volume increases with global spending, they have extremely high margins, there's very low capital expenditure, and the network effect creates a huge competitive moat. Mastercard benefits from long-term secular trends like digital payments, e-commerce growth, and the decline of cash worldwide. This is why Mastercard has been one of the strongest compounder in the market for decades. Mastercard has been growing its top line at over 11% annually, driven by increases in payment volume, cross-border transaction, and the global shift toward digital payments. Looking at the net income, it is growing even faster than revenue, which shows margin expansion and improved efficiency. Their model naturally becomes more profitable as payments volume increases. Looking at the free cash flow, this is one of Mastercard's biggest strengths. With minimal capital needs, most of their earnings turn straight into free cash flow. Growing a free cash flow at 16% per year gives them significant room to increase dividends, buy back shares, expand internationally, and invest in fraud prevention and security. Looking at the EPS, earning per share is compounding at over 16% annually is elite. This reflects strong profitability paired with regular share buybacks. Mastercard isn't known for a high dividend yield, but its dividend growth is exceptional, nearly 17% annually. This is backed by a strong free cash flow in long-term compounding. Looking at the shares outstanding over 10 years, Mastercard has bought back 2% of its shares. While modest, their buybacks support EPS growth and return capital to shareholders. Looking at the PE ratio, a 35 earnings multiple reflects the quality of the business. Mastercard Mastercard consistently trades at a premium because of high growth, exceptional margins, massive global scale, and strong competitive moat. In short, it's rarely undervalued, but it earns its premium through elite performance. Now let's take a look at my valuation projection for Mastercard. I'm starting with an EPS base of $15.64, and given Mastercard's long history of rapid, consistent earning growth, I'm modeling a 15% annual EPS growth going forward. That's very much in line with what the company has delivered over the past decade. For a business with Mastercard's margin, scale, and competitive moat, I think a 35 earnings multiple is appropriate. That's right in line with its long-term historical average. With those assumptions, I set my desired return at 17% per year, which is slightly higher than my target for other compounders because Mastercard has such elite profitability and growth. Starting from today's price of about $545, the projected return comes out to roughly 15.07% annually. That's still an excellent long-term return, but it falls just short of my 17 desired rate. To reach that full 17% expected return, my ideal entry point will be at around $502 per share. So while Mastercard is still offering a strong return profile at current levels, the stock is just a bit above my preferred buy zone. If the market gives us any weakness and it dips closer to that $500 range, that's when it becomes very attractive to add for my long-term dividend growth strategy. And last but not least, the last company is Visa. Visa is the world's largest global payment network. Every time someone uses a Visa, whether it's a swipe, tap, ship, or online checkout, Visa is the technology backbone moving that transaction securely from the merchant to the bank. Just like Mastercard, Visa does not issue cards or take on credit risk. Instead, it earns a tiny fee every time a transaction runs through its network. This model is incredibly profitable because it scales with global consumer spending, margins are extremely high, capital expenditure are very low, the business grows automatically as cash usage declines, and they have a dominant global network that is almost impossible to replicate. Visa also benefits massively from cross-border payments, which carry higher fees and continue to grow as travel and global trade increase. This combination makes Visa one of the strongest long-term compounders in the entire stock market. When we look at the revenue, Visa has grown revenue at over 11% annually for the last decade, driven by global transaction growth, digital payments, and the rise of e-commerce. Net income has grown faster than revenue, meaning margins have expanded. Visa's business becomes more profitable as transaction volume increases because costs stay low. Visa converts a huge percentage of its revenue into free cash flow because it doesn't need heavy investments in physical infrastructure. Growing free cash flow at over 13% annually gives Visa the stability to raise dividends aggressively, buy back shares, invest in security and network upgrades, and expand internationally. Earnings per share growing nearly at 15% annually is elite performance coming from the strong net income growth and steady buybacks. Visa is in a high yield stock, but its dividend growth rate is outstanding, nearly 17% annually. This is supported by massive free cash flow and strong earnings. Visa has reduced its share count by about 3.5%. Not aggressive, but consistent enough to boost EPS and deliver more value, again, to us, the shareholders. A 32 times earnings multiple reflects Visa's reputation for high growth, high margins, and an unbeatable competitive moat. Investors consistently pay a premium for this level of quality and stability. Now, let's break down my valuation projection for Visa. I'm starting with an EPS base of $10.19, and I'm modeling about 14% annual EPS growth going forward, which lines up extremely well with Visa's long-term track record. For a business with Visa's margins, global scale, and near unbreakable competitive moat, I think a 34 earnings multiple is fair. That is almost in line with long-term average, but it reflects the company's elite consistent in both growth and profitability. With those assumptions, I set my desired return of 15% per year. Visa is one of those rare companies that can actually deliver that kind of compound over long stretches of time. Starting from today's price of $330 per share, the projected return comes out to around 15.11% annually, which is right on target. To land exactly at a 15% expected return, my calculator for entry point will be around $331 per share. So based on these assumptions, Visa is trading at basically fair value for the return I'm targeting. It's not a discount, but it's also not overpriced. And given Visa's quality, hitting fair value is usually a great long-term buying opportunity. And that wraps up the companies I'm buying or keeping an eye for the month of November. All four of these businesses, ADP, S&P Global, Mastercard, and Visa, share one thing in common. They're elite compounders with strong fundamentals, consistent earnings growth, and a long runway ahead of them. These are in flashy momentum plays. They're long-term engines of wealth that keep delivering year after year. As always, this isn't financial advice. It's just my personal investing journey and opinion. My goal is to document the process, stay disciplined, and keep stacking quality companies month after month. If you found this breakdown helpful, make sure to hit the like button, subscribe, and drop a comment letting me know what you're buying this month. Thanks for watching, and I'll see you in the next episode.